everyone, this is Kelly.
And this is Paul.
We are the Property Hunters. Welcome back to our channel, the best place for property investors and homeowners. In today's episode of ATE, Ask the Experts, we've invited Khim, Director from Synergy Financial Advisors, here with us today.
So as property investors ourselves, as well as all the investors that we have helped, a lot of time we were being asked with these questions, or even if we don't ask it, it's somewhere at the back of our head. We are thinking that what happened if, having investing in all these properties, what happened if I couldn't afford to pay this property? What happened if something happened to me? Especially me or myself, I'm actually the sole breadwinner for the family. And what happened if something happened to me? Who is going to pay for the house? Will my children, my family be chased out of the property itself? So having investing in properties, we do calculated risk, but at some point of time, there are certain risks that we couldn't calculate or foresee. That's why I have here with us Khim, who is a personal friend, and we have invited her to share with us some of the pointers to take note to take care of such unforeseen risks. So Khim, how can we go about safeguarding our property for such unforeseen circumstances?
Paul, that's a very good question. I will say that you can make plans in your financial plan, your overall financial plan, to incorporate the ability to offset the risk should some unfortunate events take place. For example, we can have policies that cover the scope of demise, which is death, or total permanent and/or total permanent disability, critical illnesses of various stages, for example, or loss of ability to work due to accidents or illnesses. These are all different ways of arranging coverage to mitigate that financial risk should something happen to the person who is financing the housing loan before the loan is paid up.
What about safeguarding the property?
Safeguarding the property in what?
Against like sudden events or sudden losses. What can we do to actually help to reduce that kind of risk?
Okay, well, I'm sure most of us have read in the papers lately there have been quite a few fires in different parts of Singapore. So if our consideration is fire or, for example, burglary, theft kind of scenario, some of these incidents that can be covered, burst of water pipes, we can actually buy content cover to cover the property that we purchased, so that if there's any damage, any loss incurred, we can actually claim the sums from the relevant insurer.
Okay, so this is to safeguard against like events such as fire and floods and all this. Okay, what about what Paul said, about when there's something unforeseen that happens to the sole breadwinner of the family? What can we do to safeguard the property in that sense?
Exactly.
First and foremost, of course, when you commit to a property, you should have done numbers to manage your cash flow and not overcommit. So we are talking about your servicing of the loan ratio being about 30-35% of your income to begin with. Then the next step as part of normal regular financial planning is that you should set aside a buffer of close to 6 months or 9 months of your regular daily expenses, so that in the event that there's a loss of job, for example, we still have the ability to fund the loan for that tenure. And some people set aside CPF funds in investments to be released in the event that such incidents take place, so they can use the CPF OA to fund the housing loan, for example. So these are all steps that can be discussed prior to the purchase of a housing property, of a home.
Okay, and what if, like, for example, like what Paul mentioned earlier, if the person, for example, something unforeseen happened to them, they lost the ability to work, or like you said, unfortunately, maybe, he passes on, for example. Okay, then what can we do to actually reduce the risk of losing that property?
Okay, typically speaking, what we need to remember is that if we leave behind a home that's encumbered with a loan, that means it has an outstanding mortgage loan to be paid, we need to know that the beneficiary must be assessed by the bank to have the financial ability to take on the loan that's outstanding, if we do not make any arrangements to help pay up more of the outstanding loan. Now, what we can do is we can set up a coverage on the parties who are financing the loan in the respective ratios that they're responsible for paying towards the loan, so that in the event that either party were to pass on or to be struck with critical illnesses or become totally permanently disabled, the loan can actually be paid up. So there are different ways of arranging. We can do it such that the loan is fully paid up. We can also do it such that the loan is partially paid up. It's all up to the individual's wish and preference, as well as also the consideration of cash flow when making a decision just how far a scope to buy for mortgage insurance.
Okay, so when it comes to mortgage insurance, do we, for example, like Paul and I, we have a home together, right?
Yes.
Do we buy for me, for him separately or together? How does it?
Especially we just bought something and we maximize it and in order to actually go for a property like that. So this is something that I really want to learn from you.
Okay, you can cover jointly. In the event that we do that, what happens is that the sum that's paid out in the event of either parties having the whatever scope that we choose to cover would be sufficient to pay off the loan outstanding. So it's an either-or scenario. We can also buy separately. The plus point of buying separately is, of course, flexibility. And also in the event of a common accident happening, we will have two sums being paid out, one being sufficient to offset the outstanding housing loan, and the other will be extra.
So is this considered a term loan, a term mortgage?
Yes, it's a term plan. So it's
a
high
term
cover,
plan.
low cost kind of
I
product.
see. So it's not kind of like a mortgage insurance. It's more of like a term insurance, but structured in a mortgage way. Is that
Okay,
how it works?
maybe from the technical standpoint, a term plan in our industry means that it means a plan that does not accrue cash values. So in other words, in the interim, if we decide to give up the product, there's no money to take back. Okay, so that's what we call a term plan. Now, a mortgage insurance is a type of term plan, so it has no cash value, but it's structured in such a way that the coverage, right, actually drops in accordance to the prediction of how your mortgage will actually drop over the years. So what we need to take note of is, of course, that if we follow the pattern of paying up the loan, that means we don't prepay, we don't offset the loan quickly because we suddenly become cash rich at some point in the tenure, then the drop in the coverage will be just nice to cover whatever outstanding loan at the point of the event.
Got it.
Okay, so it is a format of a term cover. You can, of course, choose to buy what we call a level term rather than one that decreases over time. It's a preference. I will say consult with a financial consultant because we have at times realized that the level term can actually be priced better than the decreasing one. So why not then?
I see. So
Okay.
it depends on different promotions. At
Yes,
different time.
correct. Yeah, so do your numbers and check the various options available, the permutations involved, and what's the costing to evaluate what's the best proposition in terms of value. Okay, I just want to highlight one point. If we do it separately, it does help for families who are thinking of using property as an investment tool and who plan to buy, sell along the way. Because if you want to do that, you need to know that the mortgage insurance that you purchase follows you, is tagged to you, it's not tagged to the property. Yeah, so if let's say I bought a 2 mil outstanding loan property, and I bought a 2 mil mortgage insurance, then it slowly decreases over time, such that at another point I've decided to sell my property and take on another property, and let's say at that point I have 1.5 mil of loan left. But because of my transaction, I again top up and buy another property with a 2 mil loan sum. Then what happens when you consult with a consultant is that if the tenure matches, the outstanding tenure of the mortgage insurance matches, we can just top up the differential of a 500k cover rather than buying the full 2 mil all over again and be charged a higher price because you're now older.
I see. Because this is a very valid one. Because I mean, for property investment, sometimes after 5 years, 7 or 10 years, we will sell it. So you're saying that we can actually top it up.
Correct.
Instead of rebuying a new one,
Yep.
especially when our age, as we grow older, it's harder and more expensive to buy a term.
Okay, let me
insurance, I
clarify.
guess.
What I mean by top up is buy another policy with the net difference sum so that your exposure is still fully covered.
For that property value.
Yes, but you don't need to buy the full 2 mil, you buy the differential of half a mil.
How is mortgage insurance different from the home protection scheme that
Because
because
typically when we take out
yeah.
a loan, you know, they will
Yes,
ask us to
no,
buy a home protection scheme.
when the one using the CPF, right? That
Yes,
we were buying. Yes.
Okay, let's get it clear. HPS, the Home Protection Scheme, is only available if the purchase is a HDB to begin with. It's offered by the HDB board, right? So it's not offered if you buy a private property.
That's
So that's one distinct difference. But for those who are buying HDB, do note, of course, when you have HPS, you have the flexibility of using your CPF OA to finance the insurance cover. But you don't tap into your cash resources for it. But the HPS is one that follows the property tagged to the person, so it does not continue on for the next HDB. You rebuy a new one when you.
So if I sell the HDB, the HPS is
terminated.
okay. Then when I buy, for example, another new HDB, then I have to buy another new HDB.
Yes, correct.
Okay.
So
Okay,
there's
and
nothing to
understand.
take care of private properties at all.
there's no government scheme to take care of private properties in that. Like no. Okay.
Is there like the best way to actually structure a mortgage insurance that will let us benefit the most out of it?
If we are talking about a value proposition, yes, I do have a sort of an idea of a value proposition that we use 80% of the time for our clients after we show them the various options. But if you are talking about the best, it will be dependent on the wishes of the client, what they wish to cover in terms of the risk. So I was saying just now, right, we can cover for death, we can cover for total permanent disability, we can also cover for critical illnesses, whether we want to cover purely late stage alone or the various stages, including early, intermediate or late. Yeah, so we can arrange for sums to be paid out, for example, in the various events. We can also arrange that sums are only paid out for death and total permanent disability, whilst should there be any critical illness that's diagnosed, regardless of staging, premiums for the policies are waived off so that you have one less thing on your mind should diagnosis of illnesses take place. But you have confidence knowing that subsequent demise or total permanent disability will still result in the loan being paid up.
Okay.
Yeah, usually where price is concerned, that's a good value proposition. Okay, I want to highlight that for HPS, there's no critical illness involved in the scope of the cover. So if you would like to have critical illness being incorporated in your planning in terms of financial risk mitigation, then you should consider buying your own personal one and then subsequently apply for exemption for HPS.
So I didn't know that we can be exempted from HPS. I thought it's like 100% mandatory thing from the government. Okay, now that we know, thank you very much.
I have a question, Khim. You talk about term insurance. So I'm a believer of having, if I were to buy insurance, I want to get money back in return. So why should I then, why don't I just buy a insurance that maybe pay out $1 million, which is pretty common nowadays. People buy out insurance with $1 million payout. So that at the end of the day, after paying an X amount of dollars, I still get back the money versus buying a term insurance right now where I get zero out of it. So it's something, it's a burning question.
Okay, Paul, this is a very good question. I will say that we usually examine the circumstances of the client, because if you want something with cash values or with investment values, for example, we can definitely source that for coverage as an option. It's just that the premiums required or the format of paying the premium, whether it's paid out as a lump sum upfront or paid in drips over a number of years, is very different from if you buy a term product. Because term is a plain vanilla kind of product, it does not have cash values, so the commitment is also fairly low.
Okay, so it's a lot cheaper, I suppose?
Yes.
Okay.
More manageable on the pockets.
Okay, so for, let's say, mortgage insurance, right? How, the question that a lot of people ask will be, how much would it roughly cost us?
Okay, let me take a look at the code. So I did prep that, yeah?
So say, for instance, $1 million properties, $1 million loan.
If we are talking about a 30-year-old male and then taking a $1 million loan for a period of 30 years, we can get cover for close to about $600 a year for death and total permanent disability, but with waiver of premiums upon all stages of critical illnesses.
$600 a
Yes,
year.
isn't
Yeah.
that very affordable?
Yes, I'm actually very
I was
surprised.
expecting a year, a
A
month.
month. Yeah, that's what I thought as well. Oh, okay. We didn't know. Yeah.
So it is actually most of the times we discover our clients are pleasantly surprised that it's not too bad, really.
yeah, it's a year.
For peace of mind for $1 million worth of loan, why not?
Yeah, that's
Right?
true. That's true. So, how do people go about buying it? Do they purchase it from a bank or from an insurer?
Of course, you can buy it through the bank if the banker proposes it to you. You can take note that there are various different ways of arranging it. And if you would like to understand the various permutations and the costs involved, or if you want to have options apart from what the banker can propose, because typically speaking, the bank is tied up with just one main insurer. So if you want options from various different insurers out there, because the rates are all very different, the list of illnesses covered are also varying. So you might want to just check out what there is before you commit to whichever plan of choice.
See. Okay. All right. Khim, I want to ask you something as well. Earlier you mentioned something about this content cover insurance.
Yes.
Yeah, when it comes to like unforeseen events such as fire and all this. Can you share with us a little bit about it? How is it different from mortgage insurance?
Okay. Mortgage insurance deals with the financial liability in the event that the payer of the housing loan is not able to pay it because of death, illness, etc. Content cover deals with the actual things that we put inside the house and the actual facade or the structure or the building itself with respect to your property. So if your building were to, get burned down, or if theft happens, if flood happens, and things are spoiled, your furnishings, they peel off, etc., then somebody has to pay for the damage. Otherwise, you take out monies from your pocket to pay to repair everything and set it back in good order. So that's the difference.
How is it different? Because from, every time when we take a mortgage loan, right, the bank will tell us to buy a fire insurance.
I thought that's a default.
Okay, very good question.
So how is it different from this content covers?
I will say this, the banks can also give you content coverage. The thing as a consumer is that you have to be very sharp and just look at the numbers that they quote you. Most of the time when they give you a by the way policy, it doesn't match how much reno you've actually spent on your nice condo. It doesn't match how much furnishings that we bought to buy our to put into our landed property, or some of these art pieces, sculptures, or collector watches items that's all within the premises. All these items can actually be covered appropriately to the value that is worth for various different events if you structure it properly.
So content covers insurance also, covers like theft and burglary, you're saying?
Yes.
Wow.
Yeah. So there are also very unique coverage available for people who have a good collection of jewelry and watches, for example. Then for jewelry, there are some that will pay to replace the full set, even if just one of a pair is lost.
Oh, that's nice.
Yeah. So what they have at the banks usually is a bare bones. What we like to highlight to consumers is to take note of the valuables you have within the house, and then of course the expense that you've incurred in renovation. You don't want just a fire that spreads from your neighbor's house to burn everything down and say, oh, who do we claim the money from?
So the insurance that we usually buy from the banks, right, they don't cover neighbors' damage, third parties' damage?
Okay. It really depends from one to another, but I will always highlight to consumers to look at whether it states that it does. It may not.
For third-party insurance, when you say third-party insurance, does that mean that it covers the neighbors already?
Okay, for personal liability cover, it covers the owner's responsibility for all incidences that start from his own home.
Okay.
So if a fire breaks out from our property and spread to our neighbor's property, the neighbor can actually come and sue Kelly and say, Kelly, the fire started from your home, my house was damaged.
I see.
Okay, so they can sue you for that. Or if people come in the house and due to whatever works that's being done, somebody gets injured in the process, they can also sue.
So all these are not covered by the generic ones, right? So
Yeah, you have to look very specifically.
I see. Okay. Thank you for highlighting that to us.
That's something new that I learned. I didn't know that my neighbor can sue me for
Yes,
that.
yes, yes.
Okay.
Okay, let me bring up another point. Okay, we want to also highlight for mortgage, so for content cover, people need to take note whether there's any penalty if you're underinsured. Because you know, you buy a property, right? Then along the way you add more furnishings, you add more collector items, etc. And what if you forget to update the insurer and actually your valuation has gone up so much more than what you've actually purchased as a coverage amount? What happens in that kind of scenario? So we have policies that structure an automatic additional cover year on year, okay, to cover for such incidences. But we also have policies that don't. We also have some that will penalize in the event of underinsurance. So if let's say, oh, my property has contents worth 1 million, I only
Why
buy.
would that so? If it burns off my $1 million painting, you know, what has it got to do with the insurer? Why would they penalize me for that?
This is $1 million worth of painting,
Okay.
but we only buy $500,000 worth of cover.
Okay.
So should a fire take place,
Yes.
and then the assessor comes down to look at the damage and say, this painting is actually worth 1 mil, but Paul bought only $500,000 worth of cover.
Yeah.
So because you paid only for half the coverage, the payout will only be half of whatever sum assured that we purchased.
Wow.
Okay,
That's cheeky.
but no.
Okay.
It's just how they explain so that people buy appropriate amounts that's
I see.
sufficient. Otherwise, you pay less premium, you know, but you expect to get paid in a scenario like this. Of course, some of you may know that there are policies that cover first loss on a first loss basis. Then that style of coverage, right, they will cover up to the sum that is stated. There's no underinsurance calculation like what I explained
Yeah,
earlier.
I think that's fair.
So you need to know your insurer.
Okay, got it.
Okay?
Got it.
Okay, we are very thankful. Thank you very much, Khim, for being with us here today.
Thank you to
It
both of
has
you.
been a very eye-opening session. Yes, we have learned a lot. Yes, we've learned a lot from Khim. So if you do have any questions on, say, mortgage or content covers insurance, you can feel free to reach out to Khim. Contact details are over here. So I hope today's Ask the Expert talk show has been beneficial to you guys. If you enjoyed this video, do give us a like, share, and follow us on our YouTube, Instagram, and Facebook channels, where we'll bring you more tips and strategies on property investments. Alright, till the next episode, thank you very much for being with us here today. Thank you very much. Bye-bye.
What is loan to value LTV?
Improvising on LTV is a bit tough. So as mentioned, it really happens when you make the purchase itself. So if you have an existing housing loan, okay, no matter what, you'll never get 75%. It's a